Australians are getting squeezed from every direction right now. Rent is at record highs. Groceries cost more every quarter. Power bills land like a punch every 3 months. And yet, quietly in the background, most of us are throwing money at things that deliver almost nothing in return. This is not a video about cutting your morning coffee. Life is short and coffee is good. This is about the specific traps that cost Australians real money, sometimes hundreds of thousands of dollars over a lifetime, without anyone stopping to question them. Let's go through them one by one. Number one, comprehensive car insurance on a car that is not worth insuring comprehensively. Australians love their cars, and insurance companies love that Australians love their cars. Comprehensive cover on a vehicle worth $8,000 can easily cost $1,500 to $2,000 a year. That is 20% of the car's value every single year to protect a depreciating asset. If the car gets written off, the payout barely covers a replacement. Meanwhile, the premiums have been quietly draining the account for years. Third-party property insurance is a fraction of the cost and covers the scenario that actually matters. Damaging someone else's vehicle or property, run the numbers on your specific car before you auto-renew comprehensive cover out of habit. Habit is how insurance companies get rich. Number two, private health insurance you do not use and have never actually reviewed. Private health insurance in Australia is one of the most misunderstood financial products in the country. Most people take out a policy, pay the monthly premium, and never look at it again. The loading penalty for not having cover by 31 scared them into signing up at 30, and the direct debit has been running ever since. Here is the problem. Hospital cover with a high excess, sometimes $750 or more, means that for most health events, you're effectively paying the bill yourself anyway. And extras cover, the dental and optical and physio component, frequently pays out less over the year than you paid in premiums. The Medicare levy surcharge is real, and for higher earners, avoiding it makes sense. But the answer to that is not necessarily the most comprehensive policy available. Review your cover once a year. Ask what you actually claimed in the last 12 months. If the answer is nothing or close to nothing, you're probably overinsured and underpaying attention. Number three, mortgage offset accounts you are not using correctly. Every dollar sitting in an offset account reduces the interest calculated on your mortgage. That is a guaranteed tax-free return equal to your mortgage interest rate. Currently, somewhere around 6% for most variable rate borrowers. But a significant number of Australians with offset accounts are not keeping their money there long enough to benefit. They are leaving it in a separate savings account, earning 5%, paying tax on that interest, and meanwhile paying 6% on the mortgage balance that the offset could be reducing. The offset account is one of the most powerful financial tools available to an Australian homeowner. Most people treat it like a spare drawer. Number four, paying loyalty tax to your bank, your insurer, and your energy provider. Australian companies, banks, insurers, electricity retailers have built their pricing models around one human behavior: inertia. The best rates, the lowest premiums, the cheapest plans all go to new customers. Existing customers who do not call, do not compare, and do not threaten to leave pay a premium for their loyalty every single year. The average Australian who spends one afternoon comparing their mortgage rate, electricity provider, car insurance, and home insurance, and actually switches or negotiates, typically saves between $1,500 and $3,000 a year. One afternoon, once a year. That money is just sitting there waiting to be collected by anyone willing to make a phone call. Number five, extended warranties from retailers. You are at JB Hi-Fi buying a laptop. The salesperson leans in and offers you 3 years of extended cover for $299. It sounds responsible. It feels like the careful choice. It is almost never worth it. Consumer law in Australia already gives you significant protection that retailers do not advertise. Under Australian consumer law, products must be of acceptable quality for a reasonable period based on their price and nature. An expensive laptop breaking after 14 months may already be covered by statutory guarantee, regardless of what the manufacturer's warranty says. You have rights that exist independent of any extended warranty you purchase. On top of that, many credit cards in Australia automatically extend manufacturer warranties by up to 12 months. Check your card benefits before you pay for cover you already have. Number 6, letting multiple superannuation accounts drain in parallel. This one is not a purchase, it is an omission, and it costs Australians billions of dollars collectively every year. Having 2 or 3 super accounts open means paying 2 or 3 sets of administration fees, 2 or 3 sets of insurance premiums, and watching 2 or 3 small balances underperform because none of them are large enough to access the best investment options. The ATO estimates there are millions of lost or duplicate super accounts in Australia right now. If you have ever changed jobs, worked casually, or moved interstate, there is a reasonable chance one of your old accounts is out there doing nothing useful and costing you something real. Consolidating takes 20 minutes through the ATO portal. The long-term impact on your retirement balance can be in the tens of thousands of dollars. Number 7, rent to buy and buy, now pay later for everyday purchases. Australia has become one of the most enthusiastic adopters of buy now, pay later in the world, and it shows in household balance sheets. The model is elegant in its design. No interest, easy approval, small fortnightly payments. What it actually does is detach the purchase from the price entirely. You stop asking whether you can afford something and start asking whether you can afford the first installment. Those are completely different questions, and the gap between them is where the financial damage happens. Across 3 or 4 active plans, the weekly drain can hit $100 or more. That is $5,000 a year, leaving the account in small, forgettable increments that never feel like a budget problem until the whole picture is laid out. Rent to buy is worse. The total cost of a $1,200 television bought through a rent to buy scheme can exceed $3,000 by the time the contract ends. The weekly payment feels manageable. The final price tag is anything but. Number 8, managed funds with high fees when low-cost index funds exist. Australia has a thriving industry of actively managed funds, charging fees of 1 to 1.5% per year on the promise of beating the market. The evidence accumulated over decades across markets and fund managers globally is clear. The majority of actively managed funds underperform their benchmark index over 10 years or more after fees. The ones that outperform in one period rarely sustain it in the next. A 1% annual fee sounds harmless. On a $200,000 portfolio growing over 20 years, that 1% fee compounds into a cost that can exceed $100,000 in foregone returns. That is not a small difference. That is the better part of a decade of contributions. Low-cost index ETFs on the ASX, VAS, VGS, IVV charge fees of 0.03 to 0.18%. They own the market rather than trying to beat it. And over the long run, owning the market has beaten the people trying to beat it more often than not. Number 9, upsizing to a home based on borrowing capacity rather than actual need. When a bank tells you that you can borrow $900,000, that is not a recommendation. That is a ceiling. The bank's interest is not aligned with yours. The bank benefits from a larger loan. You bear all the risk of it. Australians consistently conflate borrowing capacity with affordability. The result is households stretched to a mortgage that consumes every spare dollar, leaves no buffer for rate rises, and turns every unexpected expense into a genuine crisis. The home you can technically borrow for, and the home that allows you to also invest, save, travel, and handle a job loss without catastrophe are often not the same home. Running the numbers honestly, not just on the repayment, but on the total financial picture, before committing to the biggest financial decision of a lifetime is not optional. It is the entire game. Number 10, lifestyle inflation that moves in lockstep with every pay rise. This is the most expensive item on the list because it has no invoice attached to it. You never see the charge. You just look up one day and wonder where the money went. Every time income increases, spending increases to match. The apartment gets upgraded, the car gets replaced, the holidays get longer, the restaurants get better, the wardrobe expands. None of it is unreasonable in isolation. Together, it means the savings rate stays flat, the investment account barely moves, and the pay rise that felt significant produces almost no change in the underlying financial position. The Australians who build real wealth on average incomes are not the ones who earn the most. They are the ones who, when income grows, direct a meaningful share of that growth into assets before lifestyle has a chance to claim it. Not all of it, not most of it, but enough that the gap between income and spending compounds over time in their favor instead of the other way around. None of these are about living smaller. They are about spending deliberately. The difference between a financial life that works and one that perpetually feels tight is rarely income. It is almost always the quiet, habitual, unexamined spending that nobody ever stops to question. Question it, run the numbers, then spend more on the things that actually matter to you. Now, if this gave you something useful, hit the like button and subscribe. I will see you in the next one.